S&P said no to $1.75 trillion. What happens next? What if one decision from a major financial institution could impact billions of dollars, shake investor confidence, and change the future of entire industries? Today, we're talking about a headline that has caught the attention of investors, economists, and business leaders worldwide. S&P said no to $1.75 trillion. But what exactly does that mean? Why does it matter? And most importantly, how could this affect everyday investors, businesses, and the future of the economy? Stay with me because by the end of this video, you'll understand the bigger picture behind this massive financial story and what lessons smart investors can learn from it. Welcome back to AI Wealth Hub. Let's dive in. 1. Do what is S&P. Before we talk about the $1.75 trillion figure, we need to understand the role of S&P. S&P stands for Standard & Poor's. It is one of the most influential credit rating agencies in the world. Governments, corporations, banks, and investors pay close attention to S&P ratings because they help determine financial credibility. Think of S&P as a giant referee in global finance. When S&P approves something, investors feel more confident. When S&P raises concerns, markets listen. Their ratings can affect borrowing costs, investment decisions, corporate valuations, government funding. That is why headlines involving S&P often create major reactions. 2. Understanding the $1.75 trillion ISU. Let's talk about the number itself. $1.75 trillion. That's not million, not billion, trillion. To put that into perspective, larger than the GDP of many countries. Enough to fund countless infrastructure projects. Enough to reshape industries. When S&P says no to something connected to this amount of money, it signals serious concerns. Possible concerns include excessive debt, financial instability, risk management issues, market uncertainty, economic sustainability. Financial institutions don't make these decisions lightly. They evaluate enormous amounts of data before making a judgment. And when they do, investors pay attention. 3. Why investors are worried. Markets thrive on confidence. Confidence drives investment, business expansion, lending, innovation. But when confidence weakens, uncertainty grows. Imagine you're lending money to someone. Would you rather lend to a person with a strong financial history or someone carrying massive debt? The same principle applies to corporations and governments. A negative assessment can trigger reduced investment, higher borrowing costs, market volatility, slower economic growth. This is why S&P decisions often make headlines around the world. For the AI connection, you may be wondering, what does this have to do with AI? Actually, quite a lot. Artificial intelligence is attracting billions of dollars in investment. Companies are spending heavily on AI infrastructure, data centers, semiconductor technology, cloud computing, research and development. If financial markets become more cautious, funding for large projects can become more expensive. That means even AI companies could face challenges securing capital. The future of AI doesn't depend only on technology. It also depends on financial confidence. And that's why investors are watching these developments closely. 5. Lessons from history. This isn't the first time financial markets have faced major warnings. History teaches us valuable lessons. We've seen periods where low debt levels rose rapidly, asset prices became inflated. Investors ignored warning signs. Eventually, reality caught up. Smart investors understand one important principle. Risk management matters. Successful investing isn't just about finding opportunities. It's about avoiding unnecessary risks. That's why professional investors monitor signals from institutions like S&P. 6. What could happen next? Several scenarios could unfold. Scenario 1. Markets stabilize, investors regain confidence. Companies adapt. Economic growth continues. This would be the most positive outcome. Say Scenario 2. Increased volatility, markets react cautiously. Prices fluctuate. Investors become more selective. This creates both risks and opportunities. Say Scenario 3. Long-term economic impact. If concerns remain unresolved, borrowing costs could rise, businesses might slow expansion plans, investment activity could decrease. This would have broader implications across multiple industries. 7. What smart investors should do during uncertain times. Diversify your investments. Stay informed. Avoid emotional decisions. Focus on long-term fundamentals. Remember, the biggest mistakes often happen when investors react out of fear. Successful investors stay disciplined. They analyze facts, they think long-term, and they understand that every challenge creates new opportunities. So what does it mean when S&P says no to something connected to $1.75 trillion? It means markets are paying attention, investors are reassessing risk, and financial confidence is being tested. Whether you're interested in stocks, AI companies, technology, or the future of the economy, understanding these signals can help you make smarter decisions. What do you think? Will this become a major turning point, or is the market overreacting? Let me know in the comments below. If you enjoyed this video, make sure to like, subscribe, and turn on notifications so you never miss future insights from AI Wealth Hub. Thanks for watching, and I'll see you in the next video.